past 6 months, equity markets are up over the period, and that's despite some volatility through February and March. So through the last quarter of 17 and particularly into the first month of 2018, January, we saw pretty good strength across most major equity markets. And that was really driven as a continuation of the themes that we've seen through the rest of 2017, which was strong global economic growth, very strong earnings, very supportive monetary and fiscal conditions, and generally looking forward into 2018 expectations of US tax cuts. We do recognise, however, that we're late cycle, and when we had a stronger than expected wages number coming out of the US in January, that did see a little bit of volatility coming into the market, and that was despite the February number actually being somewhat more subdued. However, we then had some global trade tensions which bubbled up through February and into March, and also technology stocks in the US, which do look very fully valued, and some concerns around regulation there. And that's just introduced quite a lot of volatility through the last 2 months, being February and March. All in all, we saw markets peak around the end of January, peak to trough falls of around 10%, so a decent correction, although markets have really now looked through into the better earnings profile for 2018, and we have seen some rebound from those lows, although we haven't seen those equity markets reach their previous highs yet. In terms of bond yields generally up over the course of the 6 months. The US really leading the charge there as we look forward to further Federal Reserve rate hikes through 18 and into 19. And also some concerns about inflation pressures potentially coming through. The Australian dollar, pretty much range trading, tends to do better in a risk-on environment. The volatility we saw in equity markets did see it come back a little bit, but it's very much been in that range now for a couple of years. Over the course of the past 6 months, the funds have actually done very well, really benefiting from diversification. So we have seen higher bond yields, which has meant returns have been very low from that segment of the market. That's also impacted on things like listed property and listed infrastructure, which are bond sensitive. But the strength in equity markets have really driven returns higher. So across the range from most conservative through to highest growth, we've seen returns in the order of around 2%, right up to about 4.5% over the 6-month period. If we look forward through the rest of 2018, we see really a continuation of the themes that we saw through 2017. Global growth should continue to be good, and it should be synchronised. We're seeing some early signs that perhaps we've seen the top, but certainly no red flags for now. We do expect that we will see the Federal Reserve continue to increase cash rates in the US, and that may introduce some volatility into markets. Earnings growth in the US should be around 20%, driven by tax cuts, which is a very supportive environment. Similarly, in places like Europe, we're seeing double-digit earnings growth. And for that reason, we think that really global equities are going to remain pretty well supported, particularly given where bond yields are. The issue really will be into 2019, where we are expecting quite a lot of fiscal stimulus in the US, and we may get to a position where markets really start reacting potentially to overheated market in the US. So 2018, we think, quite supportive for equities, risks increasing into 2019 as growth slows, perhaps inflation starts to pick up more aggressively and we see higher bond yields. So we haven't made too many changes to fund positioning. We're remaining fully invested in equities. We still think that the risk premium that you're getting is supportive of staying there. If you look at our positioning, however, you can see that we're underweight Australian equities, where the return profile and earnings profile is not as good as it is globally. We also underweight US on valuation grounds and leaning into Europe and Japan. At the sector level, financials is an area that we think has probably been a little bit unloved globally, and we're expecting financials to do better from a market perspective, so we have a tilt there. We've recently introduced a position to global energy. Supply dynamics quite supportive of that position, and it's the sort of position that will handle the volatility that we might see going forward well. A very underweight fixed income. We've had that position for a while. We would be looking for higher yields before we'd be looking to go back in there, and also underweight corporate credit as well. And that means we've got a slightly higher weight to cash than we like, but we'll obviously use market volatility to spend that as we see valuations changing.